In this week's update, how to navigate this very difficult market. Opportunity doesn't disappear, it just moves. And the impact on commodities. My name's Gary Davis, I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. The markets continue to be extremely volatile and almost impossible to decipher on a day-by-day, week-by-week basis. And if the war ended tomorrow, and who knows when that is going to occur, but it's certainly looking like it's longer rather than shorter, then there's already been very, very significant damage done to oil and gas infrastructure in the Middle East. And so this is not just a matter of you end the war and then you turn the taps back on and things get back to normal pretty quickly. In the case of the Qatar LNG infrastructure, it could take several years for that to be fully up and running again. So the impacts of what has happened so far in the last month are going to be felt for a considerable period of time. The other factor, which is related but separate, is I think there's a lack of appreciation in Australia for our lack of independency, our dependency on just about everything. We used to have 8 oil refineries, we've now got 2. The government is talking about they've now got a plan that will just keep our nose above water. This is an issue that's been around for decades, and successive governments have failed to do the right thing and still don't really get it. I think there's just not the political will in this country on any side of politics to actually address the problems and fix them properly. The likely consequences out of this, these are all pretty obvious. We just don't know the degree, but inflation just has to come back, probably to a significant extent. We're going to have supply disruption. We are getting supply disruption to most things. It'll probably be worse than COVID, and without having done any sort of study at all on this, I just don't remember that the supply of oil and fuel was threatened back during COVID as it is being now. I might be wrong on that, but it's just my kind of gut feel. And because the supply of energy and hydrocarbons is just fundamentally critical to the way the whole planet works, I think potentially this supply disruption could be worse. Many companies' margins and their operations are going to be squeezed, are being squeezed already. And the most critical one of all that's becoming very apparent is food, the supply of food in Australia. And the worst part about that is that the narrative coming out of the primary industry is that some people have had enough and they're going to walk away from the land. So we might end up going down the same route that we've gone on so many other parts of our economy, and that is that it's not just a matter of a temporary problem, but it's one that persists and actually becomes permanent. That's the concern. We're seeing production curtailments again in the primary industry sector. We're just not going to have the supply that we used to have, and that's happened already. Now, the consequence of all that as far as investing in the stock market goes is that we are going to see what I've referred to many, many times as a double banger effect on price. Earnings are going to go down, so that is going to pull the price down. But also, because earnings are going down, the PE multiple that the market has been awarding companies will also compress. And so you get this double squeeze on the share price. So it's potentially a very poor situation, and therefore investors really do need to take notice and make whatever adjustments they need to make. But it certainly is a serious situation. And when you look at hydrocarbons, so this is more than just fuel, it's also the availability of hydrocarbons that drive pretty much everything in our daily lives. So there is very, very little in our economy that's not immune, either directly or indirectly, from the availability of hydrocarbons. And you can break it down broadly into 3 channels. We've got energy, which is the cost of power, it's the cost of heating, and it's the availability of industrial fuel to do everything that we need doing. Then we've got the transport side of things, the cost of moving people and moving goods around. And that's going to feed into much higher prices, but it's also going to lead to restrictions. And then we've got the feedstock channel. And I think this is the one that's really underappreciated by the general population, and that is the manufacture of petrochemicals, fertilizers to grow food, and of course plastics, which go into just about everything that we do and we use. So potentially this can get a lot more serious than it is now. So from an investment point of view, it certainly needs to be a time when you're reassessing your tolerance to risk. Now, that's a pretty somber kind of look at where we're at, but I think it's reasonably realistic. So what can we do about it and still generate a solid return? Because as I said in the opening, opportunities don't disappear, they just move to other places. So we've got to be very careful about how we think about this. Now, the first obvious step, which really I've been talking about since the first week of the outbreak of the war, is to raise some cash to whatever level is appropriate for the investor. There are wonderful opportunities. There's a few already, but there are wonderful opportunities that are in the making because prices are now falling to levels that we've not been able to access before. So raise some cash. It's probably just about too late now because markets really are getting down to very oversold levels. So it wouldn't be surprising to see some sort of oversold bounce in the not too distant future. Identify the opportunities. That's the second thing. You don't want to make this up as you go along. So have your targets and have your opportunities pre-thought and pre-identified. And what you're looking for are opportunities that are more immune from the turmoil. And they're out there. You may not think so, but when you really start to apply your mind to it, there are opportunities out there that are largely immune from what's going on. Have some understanding of the cycles that various parts of the economy and the stock market go through, and also valuations. We're seeing some valuations that are extremely cheap and that a month ago we wouldn't have thought were possible, but they're materializing. And then patiently wait for the money flows to confirm the turns. This is a market where you do not want to be using fundamentals to make your buying and selling decisions. This is a market where you've got to be driven purely by the price action because prices can become irrationally cheap and get to irrationally low levels because it's being driven by fear and panic and forced selling. So this is a very tricky and somewhat difficult market. And the final point that I would make in this introduction is do not buy into the Armageddon narrative. And there is a lot of it out there. And we felt the brunt of it a bit last week because there was a lot of comment about the theme that I put forward, which is that markets will rebound and there'll be great investment opportunities. Now, the fact that a lot of people jumped all over that and called me all sorts of things just indicates that their minds are made up. They've closed their mind to the possibility that this could be anything other than a disaster. And yes, I acknowledge things are crook. I've just laid out multiple reasons why things are poor and could get a lot worse. But if you buy into that disaster narrative, you can't see the opportunities. So you're actually shooting yourself in the foot if you allow yourself to get drawn into that. And I've had questions about selling everything. And if you do that, if you sell everything because you think it's just a complete disaster out there, then how do you get back in? When do you get back in? What does it look like? Just take a minute to think about if you sell everything, then your mindset is very much on the negative side and you're going to need a lot of convincing to start buying again. And by that stage, the market has rebounded very, very significantly. The opportunity is past. You're now back into high risk again. So you are missing out on the low risk sweet spot that the market throws up a couple of times a decade. This is one of those times. So you don't want to be buying into the disaster narrative and closing your mind. It does it subconsciously. So the answer here is to embrace the opportunities that are either there right now or they're unfolding because assets are just getting ridiculously cheap. and the businesses really aren't going to be that affected in the longer run. So embrace, not hide. Instead, you need to focus your attention, rather than wringing your hands about the disaster, focus your attention on what is likely to thrive, even if the current conditions lasted till the end of the year. And I don't know whether they'll end next week or sometime next year. I have no idea. I don't think about it deliberately because it's unhelpful. It plants negative seeds in your mind that prevent you from seeing the opportunities. So some people would see that as sticking your head in the sand. Far from it. This is very much about keeping your mind open so that you can see and understand the opportunities. During this period, as I say every week, it's really critical that you obtain all the advice that you need before you act. This is a time for cool heads, having your thoughts organised and not reacting emotionally to what the environment and the market is throwing at us, which is considerable. Turning to the US market now, the S&P dropped 2.1% for the week. The Nasdaq was down over 3%, so it wasn't a good week at all. We've got supports breaking at the index level. But what I am seeing, and if you recall from last week, I said that there were still plenty of stocks that were in uptrend or holding at a high level. That changed a lot last week. There is now a comparatively low percentage of stocks that are still rising. And I get to see it very clearly because I've got a workbook with hundreds of stocks in it that are going up, and I've got a workbook with hundreds of stocks in it that are going down. So I've delineated it so that I can see the difference. And the workbook that had the stocks that were going up, there are now far less of them that are still going up. A lot of them are now breaking down. So what I'm seeing is sellers grabbing control. So this certainly is confirmation for me that the sentiment in the market has changed. But that doesn't mean that the opportunities have disappeared. Far from it. The Russell 2000 was slightly higher last week, which I don't quite get. I'm guessing maybe that because the US is energy independent now, they're self-sufficient in energy, they're a net energy exporter, that domestic companies perhaps are being treated a bit more kindly by the market. I don't know, that's just a guess. But it just seemed a little strange to me. I expected the Russell to have had a pretty ordinary week, and that's a bit of an encouraging sign for the US market. Certainly for what we do in the States it is, because there's very, very little of our portfolios that are in the big end of town in the US. A lot of them are in small to mid-cap stocks. The energy sector obviously did incredibly well, and that's one that is justifiably an overweight position at the moment. And the energy sector went up 5.5% if you look at XLE. Now, the US dollar index, and this is a big story as well, has now risen back up to the 100 mark, and this is a critical level. The US dollar can either keep rising from here, or if it breaks 97 on the downside, then we've got a continuation of what looked like the bear market. So this is a pretty critical point, because the US dollar had been building towards a bear market for several years. But now we've got the possibility that that is now going to be overturned. We're not there yet, but it's possible. The 10-year yield, naturally, with inflation expectations going up, the 10-year yield is rising further to 4.44%. And the VIX, which has been lurking around between 25 and 30 since the war started, is now right up at the top. And 30 is a pretty critical level for me. I really take notice any time that we're over 30. So let's go and look at some charts. And we'll start with the Nasdaq. So finally, the indices have rolled over, but regular viewers of this video know that's only a second order factor for me. I look much more at hundreds of individual stock charts to get a sense of what the market is really doing, not just the index. But certainly because some of the very largest stocks have started rolling over and breaking supports, then naturally that's dragging the index with it. But what I am seeing is that there is an abrupt change in the long-term gainers. As I said before, we've got sellers grabbing control. We've got the possibility, which I'll show in a chart in a minute, of a rerun of 2022, where the top 10 stocks, top 20 stocks, went down for nearly 12 months. So a rerun of that, these charts are starting to look quite similar to what we saw in 2022. And also the sector money flows are confirming the shift in sentiment as well. We'll look at that chart in a minute. Now, specialist share education members have been receiving progressive cash up prompts throughout March, depending on what they personally needed psychologically to deal with the volatility. And they're now positioned for the next phases. Not sure when they will arrive because we're driven by what the market is actually doing and telling us. But we're certainly set up nicely to capitalise on the next phases. Now, if we look at, that's not the chart I wanted, this is the chart that I wanted. So this is consumer discretionary versus consumer staples. And this is really starting to look like a rerun of 2022, which is this period from here. So it started in late 21 and it went all the way down to December of 2022. So there was a bit of a couple of blips along the way where growth stocks and discretionary stocks came back into favour briefly and the ratio rose. So this period here, that was when consumer discretionary stocks were rising faster than staples. But for most of the time, money was very defensive. Money was flowing more into consumer staples than it was into consumer discretionary. And then, of course, that all turned around at the start of 2023 and it's been strongly up with just really the one interruption, and that was around the Trump tariffs when the market was justifiably concerned. We've broken an initial swing low in that ratio. We've had a little bit of a period where it's been in equilibrium, but we're now starting to accelerate to the downside again. So money is definitely moving more defensively in the US market. Interestingly, though, semiconductors still haven't broken down. Now, they're certainly looking like they're about to. This is a daily chart, and you can see the volumes around the last 2 days have been on the rise. So this is looking a bit shaky. We've certainly got lower highs, and looks like we're about to get some more lower lows as well. The relative comparison charts show very, very starkly where the money's flowing. Energy sector, obviously, is the only really big recipient of money flows. Then we've got materials, consumer staples, industrials, then the S&P, and then everything else is underperforming the S&P. In Australia, it's very similar. Energy has done extremely well, and at the bottom of the totem pole, we've got information technology, we've got healthcare, and we've got small caps. So the Australian market, quite a different mix to the US. And the S&P, this is on a weekly chart, you can see very, very clearly a break of support, breaking this swing low that we had in late November of 2025. And there's XLE, so that's why things are doing so well in XLE in the States. And IWM also broke support a few weeks ago, but actually finished a little higher, as I mentioned, for the week. Moving on now to the Australian market, the Aussie dollar, 68.1. So we've been up over 70 for some time. So we're now coming back to the normality that we would expect, the relationship to the US dollar. Our index was up 1.05% for the week, but will almost certainly be down when market opens on Monday morning. We've got technology and we've got smaller miners are still being beaten up. And this is where there is definitely an emerging opportunity, because there are some valuations here that are just getting to the silly, crazy level. Established businesses with growth prospects of 10, 20% are trading on PE multiples of 2 and 3. That's just crazy. And at some point, it will reverse. But at the moment, the market is driven by other things, by emotional things, and it is what it is. So you don't want to get too brave in terms of buying into these opportunities until the market shows us the right time. And we've got a situation, particularly in the mining sector now, where some operational risk is actually surpassing the valuation. So these very, very low valuations may or may not be valid, because it's not just a matter of the impact on the bottom line of higher costs, there's actually some operational risk creeping in as well, whether the operations can actually continue. It's not just about the margins. But look, how you respond to all of this depends very much on your time frame. And let me explain that. If you've bought, let's say, a copper stock, quality copper stock with a view to letting that business and that story unfold over the next 5 years, then probably not a lot has changed. There might be a hit to their earnings in the FY26 year, maybe some lingering hit into the FY27 year, but the 5-year story is unchanged. So you may elect to just sit through this volatility, and that's why it's so critical that everyone understands before they buy anything, you need to understand two things. You need to know your purpose and you need to know your time frame. And if you don't do that for every single investment you make, then you're just not investing with a rational outlook. Let's take a look at the Australian chart. So actually, just before we do that, we'll look at the currencies. So the US dollar is now, as you can see, we've got this longer term consolidation. We've been in decline for, well, really since the peak in January of 2025. So we had a very significant decline that was associated with the tariffs. We've gone sideways in a band between 96.3 and 100.5, and we're right up the top. And certainly in the short term, you can see we've got quite a decent uptrend on our hands. We've got higher highs and higher lows. And you've got to say at this point in time, the likelihood is that the US dollar will break out. And if that happens, that doesn't mean that commodity prices can't go up, but it creates a drag on commodity prices. So it just makes it more difficult for commodity prices to go up. So that's DXY. If we look at the Australian dollar, and we've come off this peak, which I thought didn't make a lot of sense, and we're coming back to where we normally kind of be in the mid to high 60s. Now, if we look at the Australian index, the ASX 200 on a weekly chart, we were sold off quite heavily at one stage during last week, but managed to rebound. But I suspect that the support has been broken and that we're probably going to see some more downside next week. Turning now to precious metals, gold rose just a touch. To all intents and purposes, it was flat for the week at around 4,500. This is another critical level. In Australian dollars, we actually went up to 65.50 with the lower currency. Silver was up 3% for the week, 69.77. And major investment banks are still consistently holding to their view, and it doesn't make it right, but they're still consistently holding their view where they're forecasting between 6,000 and 6,500 gold by the end of the year. And it's pretty hard to argue against them. I think what's happening with gold at the moment is there are transient factors that are weighing on the gold price. There are unnatural factors that aren't due to the long-term supply and demand situation. And I raised last week whether you understood how your gold producer or your advanced developer is impacted by extreme diesel costs, because they are widely different. Open pit miners with a long way to haul and no fuel hedging in place are in a far worse position than an underground miner that's got fuel hedging in place. Two very different impacts on their business. So if you don't understand what that impact is, then it's a bit of a lottery, the outcome that you're going to get, at least in the short to medium term. And the other question, as I suggested before, is that can these miners still operate at full schedule? Can they continue with their current mine plans? And that is a question that's up in the air. Now, if we look at the gold stocks, GDX listed on the ASX rose 1.4%, and the small end is showing some signs of a low, and so it should, because gold stocks have just been absolutely murdered. And some valuations there are becoming really quite extreme as well. So the bounce was to be expected. And we'll just go and look at gold and silver before I move on to other commodities. So we'll start with silver, and this is silver on a daily chart. And you can see we've definitely taken another leg down. This was the initial support area, which was basically respected in the early part of February. We then had a decent rise, but we've fallen away again. But again, my contention is that this is due to transient factors, not the end of the bull market in precious metals, not by any stretch of the imagination. And the same thing with gold. We've now got a week of effectively just bobbing up and down, going sideways. Is this the calm before the storm? And if it is this the equilibrium? But the forces driving this are going to either push it to a breakout or to a breakdown. I think in the long term, there's no question in my mind that the move is to the upside. But it could yet have another short-term move to the downside. So that's why we just need to be driven so much by what the market is showing. And finally, this is the gold price in Australian dollars. So just touching on other commodities, copper steady, just under the 550 mark. But look, we've got a situation with a lot of commodities where the fundamentals are just being overwhelmed by fear, by uncertainty, by forced repositioning to the negative side. Crude oil, we're over 101 now. Last week I said the next move is likely to be explosive, and certainly the way that it ended the week, as we'll see in a minute, it looks like we're primed for oil to go higher yet and could be considerably higher. There are calls out there for $150, $200 oil. I'm not buying into that. I'll just let the market show me. There's the spot copper chart, so really a bit of a sideways week, but there's the oil chart. And you can't look at that oil chart and say that 120 or something higher is not going to happen, because clearly that's where the momentum is. So the final message is this. My long-term stance about where these mega trends are going and the fact that they're nigh on unstoppable over the long term. So I've been highly bullish throughout since well before COVID. And the reality of those megatrends is not being changed by what's happening in the Middle East at the moment. The time frame for this interrupted period is an unknown, but the reality hasn't changed at all. And my view has not changed one little bit. So that means that sectors and stocks that are getting outrageously cheap in a long-term megatrend that will resume at some point in the not too distant future is just getting better and better value. And that's the way that you need to think about it. Now, to a degree, particularly in the technology sector, we've been starved of opportunity because they were just too expensive. I've got hundreds of US tech stocks that I would have loved to have bought on fundamentals, but there's no way I could have bought into them given the valuations and the multiples. But we're now starting to approach a period, and it may not be finished yet, but we're now approaching a period where we're not starved of those opportunities. In fact, the more the market falls, the better the opportunities become. And that's how you need to think about the market. This is a time when Warren Buffett would get really, really interested, and his track record is not too bad. So I think it's fair enough for the rest of us to not get scared, but to get interested. So your success is just so much about how you think about it. If you buy into the disaster narrative, then in my opinion, you're toast, because you can't see the opportunity, you can't see the reality. That's it from me this week. It's about as emphatically as I could put it. I'll be back with you next Sunday. Cheers.